What is passive investing? Passive investing aims to track market performance rather than trying to predict or beat the market. The most common examples are index funds, exchange-traded funds, ETFs. These funds replicate an index, for example, the S&P 500 or a global stock basket in the same proportions. The goal is not to outperform the market, but to capture the average market return. Passive versus active investing. The core differences. Passive investing. Goal: capture market returns. Cost: low. Time required: minimal. Risk exposure: diversified. Short-term forecasting: no. Active investing. Goal: beat the market. Cost: high. Time required: significant. Risk exposure: often concentrated. Short-term forecasting: yes, required. In summary, passive investing aims to capture the market average with lower cost and less effort, while active investing requires skill, constant analysis, and market prediction. Evidence on passive investing performance. These data points are important. A Morningstar report shows that over the last 10 years, only about 8% of active large-cap U.S. funds outperformed passive index funds, meaning 92% underperformed. Over a 20-year period, approximately 90% of active funds underperformed low-cost index funds. Even Warren Buffett has emphasized that for most investors, choosing low-cost index funds is the smartest decision because it often produces better results than most professional managers. These findings show most active managers fail to beat the market over time. The main reasons include higher transaction fees, management costs, emotional decision-making. Investing is not just about timing. Psychology and patience are critical factors. Why is passive investing so effective? 1. Cost advantage. Passive funds have very low management fees. Even small cost differences compound significantly over the long term, greatly impacting total returns. 2. The efficient market hypothesis. According to modern financial theory, markets price information very quickly. Consistently beating the market is extremely difficult. Therefore, tracking overall market returns often proves more successful than attempting to outperform them. 3. The big winners effect. Stock market gains are often driven by a small number of mega winner stocks. If active managers fail to capture these few stocks, they underperform the average. Passive investing includes everything, from the biggest winners to the broader market, ensuring exposure to those rare outperformers. What are the disadvantages of passive investing? Of course, passive investing is not perfect. 1. No protection from market declines. If the market falls, passive investors automatically experience losses because they track the index. There are no built-in protection mechanisms like stop-loss orders or short selling. 2. May miss above-average opportunities. Passive investing may not fully capitalize on specific sectors that dramatically outperform the broader market. 3. Could excessive passive investing distort markets? This is debated. Some experts argue that excessive passive investing may affect price discovery mechanisms, but strong scientific consensus is still lacking. The middle ground approach. Many professional investors and institutions prefer a hybrid structure. A passive core portfolio. Selected active positions. This strategy preserves cost advantages while allowing for selective active opportunities. Conclusion: does passive investing work? Yes. Scientific research, large datasets, and insights from leading figures in finance point to the same conclusion. Passive investing is a strong, low-cost, and effective long-term strategy for most individual investors. The main reasons. Most active funds fail to beat the market over time. Low costs significantly enhance long-term performance. Market averages tend to outperform short-term predictions. In short, passive investing is a real, evidence-based, and logical method for ordinary investors to achieve their financial goals.